Okay. Uh, Good evening, folks. Today, the topic for the webinar is how to build a crash-proof portfolio using some of the options trading strategies. Okay. I know a lot of people have a lot of stocks which might be accumulated over a period of years. My intention is not to provoke you to go and trade in options, but this is one of the way it is good to know about these strategies so that when we get into a situation, we at least are aware of what we could do, and then we can go from there. Okay. Okay. What is, when I say crash proof portfolio, the first thing we talk about is something called as portfolio hedging. What is a portfolio hedging? Portfolio is nothing but a list of stocks or options that you have in your portfolio. Hedging is a word that is used to say, hey, what happens if the market goes south? How do I know that I can minimize my number of losses? As you all know that market correction, whether we like it or not, happens 3 to 4 times a year. And if you know the statistics, market goes up about 53.3% of the time. I mean, I'm talking in terms of days, and it falls 46.7% of the time. So the real hedge is there is always, so the minimum difference is only 6% between up and down. So if you are not going to play the downside, that means you are losing a lot of things. So how can you hedge and how can you do that? So the portfolio hedging is nothing but a strategy to minimize losses in the portfolio. Okay. So options. Why options, right? We all trade stocks. We know that we buy it once and we do that. But why options? Options are the best vehicles available there for your risk management and portfolio hedging. Why? Because they are available for you for at least less capital. Like for example, which I'm going to show later, options are available at 1/4 the price of a stock, and you can mimic the stock action with the 1/4 of the price, which many people are not aware. And second thing about options is you can play on both the sides without the margins. I know you can short your share, short your stock, but not many people do that. But even if you have to short a stock, you have to have a margins in your account and all those things. So today, primarily, we are going to talk about 3 strategies, okay? I mean, there are many more strategies, but these are the primary strategies which I would like you to know about. And when time comes, you can use them, okay? The number one is something called stock replacement calls. That means how you can replace a stock in your portfolio with an option, and still you can have the mimicking power of a stock. Then the second one is called the dynamic hedging. That means as your portfolio changes, how can you hedge your portfolio? How do you hedge it, and you can minimize your losses, or in fact, simulate it in such a way that you don't have any losses at all, okay? Even in the downturn. And the third one is called the premium collection. Think about a situation like this, guys. Let's say the market crashes happens and you're still generating income. Wouldn't you want the market crash to happen very often? Absolutely, right? So that is what we are going to talk about. The 3 strategies are stock replacement calls, dynamic hedging, and premium collection. Okay. I'm going to show with an examples also in my thing, but just want to show this thing. Then let's go to the next one. Okay, what are stock replacement calls? Replace stocks with long-term options with delta of 0.80 or more. Okay, why I say a delta? What is a delta? Delta is nothing but, which you are going to see a little bit later when we are doing the dynamic hedging, the definition of it. But I just wanted to give the meaning of delta. Delta is nothing but it tells you the amount an option moves per a dollar move of the underlying stock price. In our last training, we covered what is an option. Option is nothing but a derivative product that is depending upon its underlying stock. For example, let's show here. I'm going to show you other screen. Please let me know if you can see. I'm just reducing it. I'm bringing in another screen. Are you able to see the screen, guys?
Yeah.
Okay. So for the benefit of the new people, this is a Domino's pizza. And you see here, the Domino's pizza is at $392.58. But we in options, like we covered in the last webinar, there are different strikes, right? For example, 350, 355, 360. That means you're telling me that I have the right to buy the stock at $360 for $33 for $34. Okay. For those of you who are new, please go back to the old webinar which we have shared in our website, which is techyinvestor.com, which I'll share with you later. But for right now, please understand that it is the right to buy. Now, let's say you're very bullish on, let's take the example of Apple, because Apple is the darling of US market. So if you look at it, let's say Apple today is around $120. Now, you want to say, hey, I want very bullish on Apple in the long run. That's why you buy the stock, right? Let's say you're expecting it to go to $200. I'm just giving a hypothetical example here. So now I want to buy something deep in the money, and I'm buying enough time. As we mentioned in the last webinar, when you buy enough time, there are two things that comes into play. One is called the intrinsic value, and the other thing is called the extrinsic value. Extrinsic value is the time that is allocated into the option value. Okay. So now, considering that, let's go, let's say we are buying Jan 21 calls. Let's remove all of these and let's go to a little bit longer. That means we have an earnings coming on October 29. So let's take two earnings. So next one will be November, December, January. So January 29. So let's say let's say March. Let's take March. So if you see March, and for the benefit of this, let's say you want to buy, if you see here, you have something called as a deltas. You see here, are you seeing guys, the deltas? Okay, I assume you are seeing that. So what you do is, let's say you want to mimic the stock, 80% of the price, right? So what you do is, you go deep in the money. The deep in the money will be, let's say this one, let's take this, 103.75. This is at 0.78, right? Now, if you see the price of this, it will be 25.50. So you can get this long-term option call, which is mimicking the stock for 80% of that 80% for $26. That is like 1/4 of the price, guys. Now think about it. If the option prices go up, this is deep in the money and it's already 80%. Let's say if the stock goes to 150, so how much are you going to make? Minimum you will make is for $47. That means you put $26 and you are making $47. That is for this price. Whereas if the stock goes to 150 and you had a stock at 103.75, you will make $47, but the amount of stock that you bought was very, very less, right? For example, let me tell you, for $100, you would have, let's say you put $10,000. So that means you would have bought how much? 1,000 stocks, am I right? 1,000? No, 100 stocks. You would have bought 100 stocks. Whereas if you put the same $10,000 in an option, how many can you buy for 26? Can anybody do the math, please? How many options can you buy?
About 380.
40 options minimum, right? 30 to 40 options.
40 options, yeah.
So 30 to 40 options. Now think about it. 40 options into $47, it will give you around $17,000 profit. Whereas if you buy the stock and if it had moved you for you like $50 also, you would have made what? $5,000. So the profit margins are very high. You will make around $20,000. And whereas here, you'll only make $5,000. So think about it, guys. The price is 1/4. The price is 1/4 of the stock, and the returns are 4 times that of the stock. Okay. So and you're buying long-term options. You are not buying short-term options. You are not saying, hey, I want to buy. You're buying March 21st. So still you will make money, and you can make. And if you think it is still bullish, you can still roll that call from March 21st to when it comes to January or February, you can roll that to the next year, March calls. So you can keep on doing this year after year after year. But some people might say, hey, the capital gains are there. Yeah, but you are overcoming it by getting 4 times the returns, right? So that is the beauty of it. So you're still making a lot more profit, even if you have to pay the capital gains. Okay, that is something I wanted to cover. That is called the stock replacement guys. Any questions on that?
Srini, one question on that. So you talked about the scenario in which the stock is going from 103 to 150, right? What about the downside if it goes down?
Exactly. The great question. That's a very good question. Glad you answered it. If it goes down, think about it. If suppose, let's say from $100, it went to $50, right? The stock, right? Now, how much is the loss? $70. 70 into 100 will be $7,000 loss for you. Am I right? I mean, I'm just giving a hypothetical.
Say that again, Srinivas. I didn't follow that.
Sure, sure. Let's say the price of the stock is $120, right? Apple, right now. Now, let's say tomorrow earnings, it went to $50 because of some bad news. Okay.
Yeah.
So what happened? If you had held the stock, how much would it have gone down? You would have lost $7,000, right?
80 times the number of stocks that you bought
Yeah.
at
100
the
shares
strike
into
price.
70 is $7,000, right?
Yeah.
Now think about the options, right? Options, first of all, let's say you want to buy only 100 shares. Let's say I'll take the same, you are replacing this with the stock. Now the same 10,000, you would have got 40 shares. First of all, the movement will not be the same as the stock. It is mimicking minimum at 80%. In fact, when it is going down, it will have a lot of extrinsic value and it will not go down that much. Let's say it goes at 80%. So 50%, $50 of 80, 80% of 50 is $40, right? If it goes down $40, now even if it goes down $40, you will still have some money left in it with the extrinsic value, and you won't lose that much money. Your losing is also less. First of all, you can put less amount of thing, and also your losing capacity is less than that of the stock because it is only mimicking it at 80%. Make sense what I'm saying? No? Yes?
Still trying to process. So the loss would be again 1/4 of 80%, or how much would that be?
Yeah, right. Basically,
okay.
80%. And the first of all, your capital was less, right? You maybe I gave you an example to buy the equivalent for 40 shares, and how much would have it would have gone down by $40, right? So even if you so $40, now what will happen with the $40? Still the options will not go to zero because they will have a lot of extrinsic value depending upon the time frame.
Got it. Yeah.
Okay. So options are always, they are not only actually the underlying stock price, they are also dependent on other things. So that's why, first of all, you can limit the risk that your capital is on. And then the second thing is the losses are not directly proportional to the underlying stock price. Okay, that's what it is. Okay, sounds good. Especially when you buy long-term options, there's a lot of extrinsic value in it. And so the option prices, if you take this $26 from 103.75, when I say the extrinsic value is how much? Right now it is at 124.40. So the 125.40 is like how much? $21 is the intrinsic value and $5 is the extrinsic value. So you may have that $5 left in it. Okay, that's what I'm saying, even if it had lost all the stuff. Okay, makes sense. Okay, let's move on. Okay, so replace stock limits 80%, less downward movement when the stock goes down. It's extrinsic value. So why? Risk management is less capital, more returns, and think about it, guys. If you don't want to buy that much, for $26, think about you had put $100,000, and you just say, I don't want to mimic that much. I want to just have a little bit of what it is. Then you can put a little bit of capital and then you can have the rest of them in the cash account, right? That's kind of a thing. So that is what it is all about. Now, so that is one way, guys. So stocks, if you are managing it very well with the long-term options, then this will be working very well. So you can definitely manage that way. The second scenario is called dynamic hedging. What happens if the market crashes? for example, the market always crashes 3 to 4 times a year, as I was already mentioning. So how do you hedge? You don't want to hedge each of the things. The most popular concept is to hedge it using the ETFs like SPY or Dow Jones. The most popular one is the SPY. So how do you hedge with the SPY? There are different techniques, but how do you make sure you're doing the right way? There are 3 techniques, guys. One is called the beta hedging. The second one is called delta gamma hedging. And the third one is called beta weighting. Okay, we'll go one by one, but I wanted to understand when I say hedge, let's say you have, it will be explained in the next slide anyway, but I just want to. So before even going to the hedging techniques like beta weighting or beta hedging or delta gamma hedging, we need to understand these geeks in the option world and in the stock world. Alpha is the most predictive one. It tells some percentage above or below the benchmark that the stock has achieved. For example, you will say Apple is 3% or 5% above the SPY, right? That's what you say. So the SPY is the benchmark and you say it's 5% above the SPY. Then beta indicates the volatility in comparison to the market index as a whole. That means you're telling my Apple stock is, for example, the beta value of Apple is 1.31. That means you're telling is Apple is 31% more volatile than the SPY. That's what you're telling. Okay, that's what it is. And as I mentioned again, delta is the change in the price of option contract for change in the dollar move of an underlying asset. That means for every dollar move in the underlying stock price, for example, when I say Apple, when we saw the delta, it was 0.78. That means for every dollar move, it will move 78 cents. That's what it is saying. So that is, then you can know what is happening. But again, as we discussed in the last, as the options becomes in the money, what will happen is there is something called as a gamma. Gamma refers to the rate of change of delta. So what it does is that this gamma keeps increasing. Ultimately, if you look at it, the delta for a stock is 1. That means for a stock, that means if it is a dollar moving, then it's moving a dollar, right? So therefore, delta is always 1 for a stock. So ultimately, this will go, the delta of an option wants to mimic a stock, that 90% or 100%. That never happens, but it can get closer to that, like 90, 92%. That will happen if it is deep in the money calls, okay? That's why when we say stock replacement calls, we want to buy something that is very deep so that we can mimic the stock to the greater extent. Any questions on this?
So
please let me know if I'm fast or something. Go ahead.
Raghu, question on this is, so is that your criteria when you say, hey, this is a good option to buy on a stock? Are you looking at the delta to say, okay, this is close to whatever, 70%, 80%, or even in some cases 90% on the delta values? Is that what's the criteria?
Yes, for the stock replacement calls, yes. Let's say you have a big momentum stocks. Later, I'm going to show you with an example. FANG stocks, right? Facebook, Alphabet, Netflix, Google. I'm sure everyone has these stocks in their portfolio, right? So when you're trying to replace it with the options, what I would suggest is go for a very long-term options, at least covering 2 earnings, and with a 0.80 or more, close to 0.80 or more on the delta, so that it will. The reason is, if your delta is lower, then your mimicking power of the stock will also be lower.
Mm-hmm.
Make sense?
Yep, it does. Yeah.
Okay. So you want to be as high as possible so that you put the less capital, but you get the mimicking power of the stock, right? That's what it is. Any other questions, guys? Okay, let's move on. So now we are going into the details of the 3 kinds of hedging techniques that we have, right? So beta hedging. Beta hedging is mostly used for stocks. Not all the stocks are the same, right? For example, if you take a big stocks like Amazon and Google, the probability of them making a dollar move is much more higher than if you take a stock like Snap which is at $27, right? I just am giving this example. So how do you treat all the stocks equally? By comparing it to some index or some hedge benchmark. And that benchmark, we call it as a SPY. We use the SPY. Now, how do you, so first of all, to hedge it with the SPY, you need to calculate the total betas in the portfolio. So what is the beta? As we mentioned before, beta is the volatility of the stock that comparison to the benchmark index. So how to get this beta? There are a lot of online calculators, and also you can use Zacks.com. They give a beta associated with each stock. For example, let's I mean, it's pretty straightforward, but I can tell you how it looks. Let me see. I'll show you later, but the online calculator, one second, let me show you that also. Okay, if you go here, let's say Zacks, Google, Beta, something like that. I'm just searching here. So if you say Alphabet, you see here, this is the beta. So the beta is at 1.10, okay? So these are the betas which is already calculated for you, or you can use some online calculators if you want, those kind of things, okay? But all this data is available for you. It's not like something you have to do it from scratch, okay? So similarly for Amazon, it's a little bit.
Question on that, right? So what does 1.1 mean? You're saying that Google is 10%.
It is in comparison with the SPY.
So it is 10% more volatile than S&P?
Yes. That's all it is. So if you take, for example, Apple, I am not sure, but let's see the Zacks Apple beta. It will be different for it. You see that it's at 1.31. And it keeps varying, okay? Depending upon the year and all those things, it has its own graphs, okay?
So you're saying the higher the volatile, the better is for the stock and the option?
But you have to understand, the higher the volatility, then the higher the risk is also about falling down, right? You are talking about hedging here. I'll tell you the reason why I'm telling this, because you will understand how much it will take for you to hedge your portfolio when you have these higher volatile stocks.
Oh, so okay. You're calculating the overall beta for your portfolio as compared to S&P.
Exactly. That's right. You got the point. Yeah. Okay, that's it. So that's what we are doing here. So if you say beta hedging, what I do, so you know how to get the beta, right? You got the beta. Offset the beta by selling the index with which the beta is compared by. Example, let's say you have a portfolio FANG, Facebook, Alphabet, Netflix, and Google. So Facebook has a beta of 1.3 and Alphabet has a this is Amazon has a 1.35, Netflix has 0.95 and 1.1. If you add all of them, it comes to 4.170. So for one share of each stock, we have to sell approximately 5 shares of SPY to have a pure hedge. Does that make sense, Raghu, what I'm saying right now?
Srini, shouldn't you take the average of that, or?
No. It's not the average, right? The reason is it's all, see, ultimately what you're saying is this is the volatility, this is the SPY that you need, 1.3. This is the SPY you need, so 4.70. So let's say you have a portfolio of like one share of each, then so let's say you want to create a straddle where you don't want any betas like up or down. You want to just be in alignment with the market. Then you want to say, you want to sell approximately 5 shares of SPY to have a pure hedge. So let's say some people, they do 50% hedge so that they don't have too much losses in the down markets. Then they will sell 3 shares of SPY or something like that. Like, it depends. So the idea behind this is why this will be effective is because you're comparing with the benchmark and you're using the benchmark to hedge your stock. Okay, that's what it is all about.
I have a question here. So let's say if I have 50 FANG stocks, so that's assuming that 50 FANG or just 50 Facebook or something. Okay. So now I have to sell 5 SPY for every stock. So this is assuming that from my portfolio has 50 FANG stocks and it has to have 150 SPY shares still.
Yeah, that's how volatile your portfolio is. See, you don't have, your portfolio is very, very volatile when you have 50. What I meant is, when you have 50 means you're telling each one, or how I don't know how you do that, but
I mean, you mentioned that for every FANG stock, I have to sell
every combination of this stuff.
Yeah, that's what I'm saying. So I'm just saying all the FANG, if I have 50,
if you want
to have
50%, if you want to keep it beta neutral, yes. But most of them, they don't do that, right? That is why it becomes very expensive with the stocks to do this. That's why people use different techniques. I'm just giving this, but I'm not saying this is the recommended approach. But if you want to do beta hedging, ultimately to have the pure hedge, then it becomes very, very expensive, right? That's what I'm trying to say, where you're saying beta neutral and all those kind of things, right? So that is why when you have these kind of stocks, when it falls big, right? You'll see a big change in your portfolio, right? Everyone. Like for example, in the March, when it fell, I'm sure everybody had a dent in their portfolio, but it came back and it also recovered everything. But when it fell, how much did you, if you had neutralized this, if you had seen the market coming, and at least if you had done a 50% hedge, you would have made tons of money even in that downtrend, right?
So Srini, help me understand when you say, okay, so you have a portfolio to the previous example, right? Let's say you have 50 FANG stocks. And now if you want to hedge it 50%, you're saying that buy SPY put options then? Or when,
no.
You're not explaining the means of hedging, right?
Yeah, I got your point. But let's hold on. Here I'm talking only about stocks, okay? But later we can also buy put options. I'm going to talk about it in the beta wave.
Even to the stocks, so are you saying you're going to short the SPY then at the point?
Yeah, exactly.
Okay.
Okay. Yeah.
So you take the opposite position, which is in this case, if you own a stock, you short a SPY then.
And you might also have a portfolio where you're already shorting. Or you might have a portfolio where you have less number of, which are, see, for example, see Netflix, though it's a high flying stock, it is performing less than SPY for right now, 0.95. So it is like if you're closer to SPY, then the lesser is same to same, right? Basically. See, it's like this, right? Think about it like this. Let's say, how do you say? You have, let's say, even in the option world, if you have 4 calls, the equivalent of it is 4 puts, right? Same thing here. Like you have this many stocks, you are comparing it with the index, and you are then saying, this is all index weighted, right? This is compared to SPY. This is actually delta. This is actually the beta of the SPY corresponding to that stock, right? That's what I'm trying to say. Are you guys getting my point? Volatility is in comparison with the index that we are considering. Okay, you'll get more when I talk about it in terms of options. Maybe here it is like a little bit. 1 second. Let's move on. So delta gamma hedging. This is again what the people do is, some people do is they calculate the total delta in their portfolio. So deltas are not fixed, you know, right? As the stock keeps moving, so gamma provides the rate of change of delta. So this one you have to be a little bit dynamic. Even betas can change, but they are not as dynamic as delta. So you need to keep adjusting. So deltas are between +1 and -1. Everybody knows that. Calls delta is greater than 0. Puts deltas are less than 0. So replace the corresponding delta with the SPY puts to hedge. Is this method accurate? I don't think so, because as I mentioned, delta measures only the movement of the option compared to the underlying stock. And each stock is different, right? In the case of beta hedging, we already compared it to SPY. But in the case of delta, we don't have any index benchmarking here. So this can work, but this is not the accurate measure of what you're doing. So like say So that's why we come across another thing called as beta weighted delta hedging. What is this? So let's look at this. Adjust each position's delta with the underlying stock price, right? And the beta of the index and the price of the index ETF. So I know it is a little bit complex, but basically what you're telling is, I will get the position delta of the index ETF of the stock in comparison to the ETF that I am using this formula here. For example, the beta weighted delta will be delta of the stock into the stock price, that is the Apple stock price, whatever it is, into the beta value divided by the index stock price. This will give you the beta weighted delta, just like how we did the beta hedging. It would give you the beta weighted delta. For example, take this Amazon. Amazon beta weighted delta for this, I'm sorry, this is not week, 3,500 calls. The delta is around 0.49 and the current price of the stock is 3,464 into 1.35 divided by 353 will give you 649 deltas. Now, either we can sell 649 SPY shares. Again, you have to remember, when you have 3,500 calls, you are getting 100 calls, right? That means that is equivalent to 649 SPY shares. Or if you can buy the 13 ATM SPY puts, 6.49 divided by 0.4, all the ATM puts will be at the money. At the money puts will be 0.50. So that means you're getting 13 at the money SPY puts. So for every one Amazon call, it is a 13 ATM puts. So why I'm mentioning this is it recommended sometimes to play these big stocks? You have to understand the volatility. You also have to understand what it comes with. If you want to make it delta neutral, then you have to consider this kind of a hedging.
Srini, rather than doing SPY, can you do XLK or something like that?
Yeah, you can do. Again, only thing you have to find is the beta with respect to that XLK.
Yeah, because XLK will be closer to a high-tech.
Yeah, you can do that. Definitely you can do that. But SPY is the most common. But yeah, you are right. XLK is the most, it will be more closer to this. But yeah, either way, what I'm trying to tell is this was based on the current price of 353. For XLK, it will be different. But again, Amazon has been like very volatile. That's why you see the movement of stock 200 to 300 to even 400 in a downward movement, right? That's what it is. So I just wanted to cover these concepts to make you guys aware for us to understand how much risk we are taking when we are buying stocks like Tesla, Amazon, Apple. It's great as long as they're going up. But if you are looking at like a hedge fund, those kind of people, they want to really hedge it, right? Because they are dealing with millions of dollars. They would do the hedge when the market goes down so that they make money on both the ways. This is how the hedge funds would do their stuff already. For retailers, it may not be that, but if you think about many options of Amazon or many options of Tesla, which you're talking about in many contracts, then we need to do this kind of a thing. Okay. Okay. I just wanted to, any questions, guys, so far? Okay, let's move on. Review of the first strategies, right? Stock replacement calls, it's nice to do because less capital and more leverage. The second one is dynamic hedging, where we talked about the different strategies, and I would refer to beta weighted delta for the maximum benefit, like so that you can be closer to what you're doing. And again, guys, when I say beta weighted delta, sometimes it may not be to do the 100% of that, but sometimes you might do, hey, I want to do 50% hedging, or I want to do 25% hedging. You can measure it with the ETF, and then you can say, oh, this is much I want to contribute for my SPYs. Those kind of things you can do. Okay, that's what I'm trying to say. So it's up to you how much you want to hedge, right? That's what it is. So 2 strategies cover your portfolio in good times as well as bad times, these 2, dynamic hedging. However, think about a scenario, guys, when you want a crash to happen. And you generate, when a crash is good and you always generate income on it. Okay, how nice would that be? Okay, That is the strategy, the third strategy, which we call it as a premium collection. What is a premium collection? Let's say getting credit. What is a premium collection is? Just like how we buy a call, that's called a debit, like we discussed in our previous video. A debit is somewhere you give money to buy, to get the right to buy. Whereas a credit spread happens when you have the obligation to sell, obligation to buy back, okay? That means you sell it and you get an instant premium. Let's take a simple example, guys. Let's take a chart and see where it is, right? 1 second. Give me a minute, guys. I want to take a and see. All right, let's go here. Let me know if you can see my screen, guys. Okay, this is the simple, let's take Apple only because we have been dealing with Apple a lot. Today, Apple crossed up and it moved to 145. So what is happening is Apple went down and it is on its way up and it closed above this flat line resistance. So this is a bullish market, right? So let's say you think Apple cannot make more than, it cannot go more than $150 and just in a down market. Let's think about a down market. Okay? Let's say in the March or April, I'm trying to see for you guys. How about the chart? This is the chart. Okay, this was in February. February, it formed a chart at 81.31. Of course, this was with the split. It split a lot of times, right? 81 times 4, it was 4 times split, right? If I'm right, it's 4 times, right? Am I right? So yeah, 330 or something, then it went up. Now, think about this, guys. It was at 81 and it keeps falling. Now, you can sell a call here and say and collect money saying that it is not going to exceed this price. Okay? You're telling, hey, I want to sell this call, and you collect an upfront premium. You get a premium and then you keep buying this and do this. Now, why do you want to sell a premium? Remember, you say, hey, if I buy stocks, I don't do this dynamic hedging. Now, it is a lot more expense for me, like Sharath was mentioning. If you buy 50 FANG stocks, you're going to spend a lot of money. How can you get money for those dynamic hedging? You can sell your premium, you can sell your calls, get that premium, and use it to hedge your portfolio. Are you getting what I'm saying? You can sell your premium for that particular call, get that money, and then you can use it for hedging your portfolio. So that's a two-way benefit. First, you're getting the income, and second, you're hedging your portfolio with that income, and you're not losing money. And once the stock goes up, you're going to make money anyway. So you are not taking any money out of your pocket, and you can just make it happen. So this is the most efficient way to do that. If you want to hedge your portfolio, sell your car, sell your product, and get your premium, get your income, and then use it to hedge your portfolio. Any questions here, guys? Maybe I'm too fast, or what do you guys think?
How do you decide what expiration and what strike price to sell those stocks? Yeah.
It depends, guys. Let's say you're hedging your portfolio. Let's say this was in February, right? And you see the stock going down, right? Today being, what I would recommend is hedge your portfolio every week. The reason is, today we have weekly calls, weekly options. So what you can do is once it reaches a particular place, let's say you have this thing, right? $81. You sell your calls here saying, hey, I don't expect it to go more than $80. Now on this is a daily chart. So let's say this is like on a Thursday, this is on a Wednesday, right? So let's say it came back here and you say Friday, and this is next Wednesday. This is what day is it? Sorry, this is 2/12. Now let's go to 2/21, right? 2/12, so that's 2/19. You come to 2/19. Now the stock is at again 81.14. It's just hovering around here. Again, you sell it saying, hey, I don't expect it to be more than $80. then keep on going here, keep on going until it hits it. Now, the moment you see a big candlestick, until you see a big candle and all those things, I mean, there are other factors coming into play like technical indicators. As long as you know where the stock is heading, you can keep on selling it week after week after week. And in fact, after weekly options are more profitable to sell, because if you sell 2 of them in a monthly, if you sell 2 of them, if you sell 4 times in a month using weekly options, that will be 2 times the premium you can get it in a month. It is proven that. So you want to get that premium going and also hedge your portfolio. So that way, you can reduce your losses when the stock goes down, and you can keep going.
And this is assuming that you own the stock, correct?
No, not really. You don't have to own the stock. Again, some people do. If you own the stock, people do covered calls. That is one way. But if you don't own the stock, you can sell, and you don't want to sell an upright naked call, short call, because that removes margins. But if you don't want the margins, you can sell spreads. For example, you can say, hey, I want to sell a call which is 80 call, and I want to buy a 75 call. So what is happening is your margin is only 500 for that spread. So that's called spreads. So that means you're saying, hey, it will stay below, as long as the stock stays below 80, you will make your money. Well, how much will you make? You'll make that $5. If it stays below 75, or you'll make the premium that you collected as long as it stays below the 80. So every week you can keep moving your spread down and down until you know, hey, the stock reached at this point, it came to 53. Now you know, hey, it's like a rock bottom based on the technicals. And then you say, oh, okay, now I'm going to play. Now I'm not going to short anymore, and I'm going to remove my hedges. And then you let the stock run. So that's what happens, guys. This is how the top players play, and then they let the stock run. And another thing, guys, when it's going up, you can say, you can start selling put spreads. Put spread is like, you can say, hey, I'm selling a put, let's say it's at 50, the lowest form is 53. You can say, I'm selling a put spread selling a put with 55 puts, and I'm buying a 50 puts. So again, you will make a premium on it. And if it closes above 55, you make money. So you can keep on moving that spread up and up and up. So like, a lot of people make this money by this is called income generation. Week after week, you can generate income. And then with that money, you can play your calls and puts. You don't have to play your naked calls and puts without that money also. So this is also one of the good strategies. Again, one thing about this is you have to wait until Friday afternoon to see that your stock is closing above the price that you sold it for. Make sense? Okay. So that's what I wanted to cover. So that is what I wanted to cover today, guys. So the premium collection, you can do that. And then the final point is, it's great to play with stocks, but there's a lot of option strategies that you can use to hedge your long-term portfolio also. So it's good to know those things and use them as we need it, especially during the crashes, because they help you to hedge your portfolio so that you don't see those big drop in your portfolio value. That's pretty much what I wanted to cover, guys, today. Any questions?
So, Srini, if you decide to hedge using SPY options, what you're recommending is to do it with the weekly options?
I didn't say hedge with the weekly options. I said collect the premium with weekly options.
Yeah. I'm sorry. Yeah.
So there's a difference between both, right? You're collecting that income week after week. For example, if Apple.
No. Actually, I was referring to that first scenario where you said, Delta Or
Beta
yeah,
weighted
this
delta
one.
hedging?
This one, beta weighted delta.
Yeah, this is hedging. This I
Yeah.
would say by long term, basically it depends upon what is your stock or options. Basically, try to hedge it in a long term, but your premium collection, collect it every week, right? You know, that kind of a thing.
So if you go back to that screen, so at the bottom, you kind of talked about either either we can sell SPY shares or buy SPY puts, right? At the money puts.
Yeah.
So the problem with buying the puts is if it is long-term puts, they're expensive, right? You know, so what is the frequency that you would recommend in that with this option?
The way I look at it, right? You're saying it's expensive, right? Expensive compared to what? That is a question, right?
Yeah.
My question is, again, as I said, different people have different, what is called, well, how do I say this? Let's say your portfolio is going down. Let's say you have a heavy portfolio, like 250 grand. I'm just giving a hypothetical example here. And you have all these FANG stocks, which are very big, right? Now, let's say all your FANG stocks are down, like the market is crashing big time, and they're down by $100, and your portfolio is coming down to 100,000. Do you have the stomach to digest it? Or you don't mind buying the puts and collecting that hedge while it is going down and reducing your losses to maybe 25,000 or 50,000, whatever, right? That's what I'm trying to say. It all depends upon your mindset, how you want to take it. But I would definitely suggest this. When it is going down, it's always good to have a hedge. In the sense, at least if you have the technicals, which we'll be doing next week, telling you when it is going down, how it is, and all those kind of things. But once you have that knowledge, it's always good to hedge when it's going down, especially if you have a long-term portfolio of stocks or something like that, because you don't want to lose. Most of the time, if I remember 2008 or 1999, there are some people who haven't still recovered from that. I still remember the US Steel, which was very, very popular at that time. Everybody bought it at $174 and it never went back to that price. That can happen, right?
Yeah. Especially with individual stocks, right? And so
yeah,
right.
Exactly. So, and obviously now, if you remember, now we are at much more risk because we are buying only these technology stocks because they are the only one. Think about it. If the whole technology bombards, what do you do?
Yeah, that's true.
So that is what, I mean, all I'm trying to tell is try to hedge your risk. See that these are all the options that are available. We can use according to our needs, right? Basically, let's say we don't have money, but we can generate the money and then we hedge it. That's what I'm saying.
So, I mean, based on your personal experience, Srini, I know you've been doing this for a long time. So what do you do? Do you hedge 25% or 50% of portfolio? How do you handle?
As I mentioned, I start small. I start with 25%. Oh, somebody's scratching. Is it me?
I don't know. Is it Tarun, I think? How's he?
Oh, wow. Okay.
Hey, I'm sorry. I was actually
25%.
No worries, bro.
He doesn't like it. Okay. I start with 25% and I go. As I see the more and more, then I keep hedging more and more. That's what I would do.
Oh, okay, got it. Okay, so you change it based.
Always anything in options, I would go incrementally, not put all in one shot. For example, even if I'm buying a call, I would go incrementally. If you're smart, you should go incrementally, seeing, hey, is it going in my right direction? For example, I'll tell you how I do. I set my order. I know I have some alerts which tells me if the stock reaches at this price, I will buy one option. I'll buy that one option and see if it is really going in my direction. If it is going in my direction, I'll add a little more. That kind of a thing. So,
okay.
So because I'm not chasing the trade, I'm like, the trade is coming to me. That's what I'm saying, right? That is how I do the things. I would also highly recommend. So that is why it's very important to know the technical. I mean, not like heavily, but at least to certain level, not to enter the options at wrong entries and all those kind of things, right? That's what it is.
Yeah. So what you're saying is you change your hedging strategy based on the technical indicators that they're seeing in the market.
Yes.
Okay, got it.
Got it. Yeah. Cool. Anything else, guys? If that is the case, I will stop the recording.